What is ahead from the Fed? 2 or even 3 50-point hikes looks likely, but is 75 on the table? Brian Cheung covers the Fed for us and sat down with Atlanta Fed President Raphael Bostic. Good to see you, Brian. What did he tell you?
Hey, Dave, we're here live in Amelia Island, Florida, where earlier this afternoon I had a conversation with Atlanta Fed President Raphael Bostic. We had a wide-ranging discussion on a number of issues, but of course, the topic du jour is the 50 basis point interest rate increase that we got last week. The first natural question, well, what's next from the Fed? Take a listen to our conversation from earlier this afternoon.
Well, for me, I think the overarching perspective is that inflation is high and it's too high, and we have to do something to work against it. So we've taken good first steps. I think the 25 basis point ratcheting up to 50 because of where we've gone. And I think that's the pace we need to stay at, getting 50 basis point increases, maybe 2 for the next 2 or perhaps 3 meetings. And let's just keep this moving to make sure that we're doing all we can to get inflation under control.
So for a lot of Fed officials, it seems like the goal is to get to neutral, at least for right now, which is the short-term interest rate that's neither stimulative nor restrictive to the economy. What's your estimate of neutral, and how fast does the Fed need to get there?
So, neutral is it's a concept, and so it's not as if there's an equation, exactly where it is. For me, it's somewhere between 2 and 2.5%. And then in terms of getting there, I think we just need to get there in a sort of methodical way, so that we are really signaling the pace at what we're going. And then, of course, we have to wait and see what happens. So as we are moving, we haven't really moved at a 50 basis point increment for many, many years. So there is still some uncertainty as to how the economy will respond. And so we'll be watching as we go along. But my view is like strong and steady, and let's get there, be very intentional about and purposeful about getting to that level.
So a lot of chatter, speculation about whether or not moving the Overton window from 25 basis points of moves to 50 basis points moves would spur eventually a 75 basis point move. What's your assessment of whether or not that's something that could be on the table?
Well, I think it's definitely on the table. For me, everything is on the table. So I really don't prejudge or predetermine in my mind things that I absolutely won't do. But the world would have to change pretty significantly. We would need to see some real negative shock on the real side of the economy for me to really bring that into a higher probability type of a possibility. It's not my baseline right now, but I'm going to be open to everything, because we need to do all we can or whatever is necessary to get inflation under control.
And it's clear that the big bright line test for that is going to be inflation. We're going to get another read on inflation in the form of the consumer price index tomorrow morning. I'm not going to ask you what your expectation is for that, but when would you expect broadly the bite of the 75 basis points in total hikes we've had between March and May to be seen in the inflation data?
Well, that's a good question. So, to me, it's heartening for me that we've already seen it take some bite into financial markets. If you look at the 30-year fixed rate, 30-year mortgage rates, they have moved far more than we have, which suggests that markets are taking these things on board. And I expect that we'll start to see that start to ripple through into the economy more broadly. I'm hopeful that over the next several months, we will start to see that inflation level start to come down in a pretty steady level. It's already gotten to a place where month to month, we're not seeing the continued acceleration in inflation, which I think is a very positive sign. And now I'm just hopeful that will continue as we move forward.
Anecdotally, when you have conversations with specifically households in your district, what are you hearing from them? I mean, President Biden was speaking, earlier in the afternoon, just kind of about how big of an issue inflation is, some fiscal policies on the table, perhaps, eliminating the Trump tariffs. Are these types of things that you're hearing from households in terms of what the Fed can do specifically to make sure prices can go down?
Every day.
The speed, rather.
Yeah, I hear about this every day. And everywhere I go, people are very much noticing that inflation is happening. I think they're open to understanding that a lot of this is driven by the COVID dynamic, where we have supply shocks that are preventing the economy from producing goods to match that elevated demand. But everyone's feeling the inflation. People tell me what the price of gas they paid this week was relative to 3 months ago. It's something that we definitely, and I have taken on board, that it is hurting people, it is creating stress for them and uncertainty. And that really goes back to where I really started, which is we really need to get this under control as fast as possible, and that's exactly what we're going to do.
One talking point that we're hearing a lot is whether or not the Fed overdid it, and that's the reason why we're in the situation that we're in right now. Is that something you also hear from households in the district?
So I'm not hearing very many among regular people theories about why we are or how we got to where we are. I hear much more that I know where we are, and I'm very sensitive to this, and it's something that I'd like to see change if possible. I actually don't think the Fed overdid it. I think that we had a great uncertainty in the economy as we were going through the pandemic experience. And for me, I think if I was going to want to do too much or too little, I'd rather deal with an economy that had strong fundamentals and foundation. We're still creating lots of jobs. We are seeing the demand that is sustained. The other alternative is losing a ton of small businesses, having families that are in much more precarious positions, and that is actually a much more painful environment to be in.
And on the labor market, the jobs data that we saw last week showing massive job gains still in the last month. We also got an unemployment rate that's still at 3.6%, close to the pre-pandemic levels that we had seen. Is there a risk that as the Fed tightens, that the unemployment rate is going to go up, that people will be maybe put out of jobs as a result of the tightening?
Well, I think there is that risk, but I would also just start where you started, which is if you're averaging, before last month, we were averaging about 600,000 new jobs a month for the last 8 or 9 months. We know that the job vacancies far exceeded the number of people that were filling those jobs. So the first thing that I'm expecting will happen as we start to slow down and retard demand is that vacancy to filling gap will narrow. So I think if we're going to see unemployment go up, that's likely to be down the road a ways, and then we'll sort of deal with it then. So, but it is a risk. It's just not one that I think we're going to have to really face in the near term.
And how do you think about that within the context of the overall concern about the Fed tightening into a recession? Because the whole idea is to tampen down demand. So that might necessarily involve 2 quarters of negative GDP. And I was talking about this with your colleague in Cleveland earlier. Not necessarily always the definition of a recession, just that metric. But by and large, there is a concern that the labor market might show signs of a recession as this process is underdone.
Well, you know, I often say I get paid to worry. So I am very aware that these are concerns. And this is why coming through most of this year, I've used 2 words to describe my approach to policy: observe and adapt. Things are going to happen as we make our policies and we move things along. And my job is to pay attention to that and try to notice when there are turns such that if we move in certain ways, that could contribute to more pain. And so then I want to adapt my strategy moving forward. And, you know, there's a lot in this economy that is complex. All the supply side issues, the war in Ukraine, those are things that are not our policies, but they will affect what our policy will need to do. And so we just really need to pay attention to that as we move forward. And my goal, and there's another thing I always say, is my goal is for us to not have a recession while I'm sitting in this chair moving forward. So I'm going to do all I can to try to get to that softer landing.
Is there a role that fiscal policy can play to help you and your colleagues on the monetary policy side out? I mean, again, talking points from the Biden administration, possibly loosening the tariffs from the last administration or doing other types of measures to try to lower prices?
Well, certainly there are a lot of factors beyond our control that are going to determine sort of the ultimate trajectory of inflation. If there's help that can come from other sources to try to either stimulate supply or reduce demand, I think the fiscal side is going to be much more on the supply issue, because ultimately what we have right now is an imbalance between high levels of aggregate demand and low levels of supply. And as you know, when demand exceeds supply, that puts upward pressure on prices. So that's that gap that we've got to try to narrow.
And then I want to ask about the housing market. Something that's very interesting is the kind of idea that the higher costs of housing that have gone up dramatically during the pandemic are going to be longer term impacts and crowd out possible spending in the future. I mean, is there any sort of longer to medium term impact that you're seeing from the rocket up in American housing prices over the last 2 years?
So we have not seen that so much, but it is a concern. And I know a number of families that I talk to are expressing concerns about where are my options and how much of my income is being eaten up by my housing costs? And it's just something we're very much going to have to watch. One of the things I really appreciate in the network of the Federal Reserve is we do lots of surveys to try to understand and identify whether there are those shifts. How we deal with, how households deal with the current environment, and housing is going to be an important component of that. And it's something we're going to have to monitor very closely.
And then one more question before I let you get back to the beautiful sunny skies here in Amelia Island, Florida. But quantitative tightening, the process is going to begin June 1 for the Fed to shrink its nearly $9 trillion balance sheet. The plan is to get it up to a $95 billion a month pace by the fall of this year. Could you see a scenario where the Fed might want to perhaps accelerate that process if it is indeed the case that maybe a stronger drawback is needed?
Well, first, I want to say I'm very excited and pleased that we're doing this. This is something that I've been saying for a long time we needed to take care of, and it's good to get that in motion. Ultimately, I think we are going to have sales. One of our principles is that most of our balance sheet holdings in this space need to be in treasuries and not in mortgage-backed securities. And so if we're going to get to that, sales will have to be part of the equation. We're just going to have to really monitor in real time to figure out when an optimal time for starting that will be. It won't be at the beginning. I think what we want to do is really see how the markets respond to our pulling out some liquidity from these spaces, and then we'll sort of have to make a decision at that point.
So the big takeaway, again, from the Atlanta Fed president, that it's really 50 basis points that is his base case scenario, at least for the next few meetings, although 75 and anything else is really still on the table, echoing what we heard from the Cleveland Fed president, Loretta Mester, who spoke with Yahoo Finance earlier this morning. You can find that conversation as well as a replay of the conversation you just heard on our site, yahoofinance.com. Guys.
You covered a lot of interesting ground there. We do appreciate it. Yahoo Finance's Brian Cheung there.